Stock market crashes. If you want to create wealth in stock market, one of the things that you need to master is how are you going to behave or how are you going to handle stock market crashes. And that's really what we're going to talk about today, of what are stock market crashes, what are market corrections, and how must one handle these. Now let's understand what a market correction is. Typically, a stock market consists of demand and supply. There are sets of people who are coming in to buy the stock, and there are sets of people who are selling it simultaneously. And there are news flows happening all the time. So the behavior of this determines whether the market is either moving up or moving down. There's always a given possibility that the news flow at that point in time is more negative than positive. As a result, there are more sellers than buyers, which means the stock market tends to trend down. And when it trends down, it is termed as a correction. Typically, a correction could be anywhere between a couple of percentage to maybe a 10% can be considered as a correction. Why this? Because this can always get recovered in short term, if not within the year. Corrections are nothing to be worried about. If you are in stock market, you will face corrections on a day-to-day basis. So be cool about it. It's got no rationale to it. It happens all the time. But market crashes are quite significant. Market crashes could take away up to 3 to 5 years of your earnings. Now, typical market crashes could be from 15-20% going all the way to 50-60%. That's the range which one would call a market crash. And this would happen within a couple of trading sessions, which means that one needs to have nerve of steel to just stay invested while there is carnage out at the market. Why is it so? Because one tends to lose not just the returns, but it also means that you are losing a portion of your capital. And that can be quite unnerving for a lot of investors. Now, here is our take. Looking at the past data, almost 20 plus years, we have picked up 3 big stock market crashes, and that will give us enough insights as to how we must behave in the face of a similar crisis. First crisis that I would like to look at is the global financial crisis that happened in 2008-9. This was at a time when there was low interest rates, and because of easy money, markets had built up quite well across the world, very, very high valuations. When some of the subprime lending cases came to fore, the markets had a crash. A big crash that started in the US soon spread across the globe. Now, in the Indian context, Sensex, which in 2008 was almost 21,000 points, fell all the way to about 8,000 points, which means that the fall was almost 60% plus. Very, very dramatic. Investors not only lost a lot of returns that they had made in the last few years, many of them lost a certain amount of the principal money that they had. Quite a harrowing thing. Lots of investors panicked at that point in time, sold their investments, be it stocks or mutual funds, at big losses and exited the market. Is that the right approach? Let's watch for a little bit more data. Second, in the instances where in 2015 and 16 we had the demonetization event, again the stock markets fell all the way from 27 to almost 23,000. Again, a fall of about 15 to 20% on the market valuation. This too was a panic situation. People tended to panic because nobody had an idea how demonetization would impact the economy. And the third event of market crash happened more recently when COVID was announced. When the government announced closure on account of COVID, it led global enterprises and global stock markets to believe that business as they knew would come to an end. The initial reaction was to sell. Therefore, again, there was a stock market crash. Market, which was at that point in time all the way up to 40 plus on the Sensex, dropped almost to 27,000 something. Again, a 35% fall in just a couple of trading sessions. Huge losses for people. But The important thing is that those who did not panic in these times, stayed put in the market, eventually found that not just that their investment recovered, but it also gave them a lot of long-term wealth. What must you do once the markets have crashed? That's really the big question. There is a 5-point formula through which one can deal with stock market crashes. First point, do not panic. It's the market's initial reaction to the bad news. Wait for it to sink in. Wait for sanity to return to the market. Do not jump in at that point in time. Second, take stock of all your investments. It's a good idea to look at your investment through the context of the current new information that is available to you currently. That's again another one. Third, if there are minor tweaks that you want to make to your portfolio based on the new data that's available, that's always right to go ahead because markets are relatively cheaper. Fourth, it's not about your investments, it's about what your goalposts are. If you still have a long way to your goalposts, just do not worry, let the market play it out. I'm sure you will realize greater value at the end of the day. Fifth and the most important is shed your victim mindset and wear the opportunist mindset. What do I mean by this? Instead of crying in wallow about the stocks that have fallen, look at how you can take advantage of the fallen market because obviously valuations are cheap. Therefore, if you make some smart moves, you would end up with a lot more money and wealth created end of the day. So these 5 steps I'm sure will help you create great wealth over a period of time. But the most important is, as Warren Buffett says, be fearful when others are greedy and be greedy when others are fearful. Stock market crash represents a time when others are fearful. That's the time you need to be greedy and you need to look at investing further money, if not just staying invested in the markets. The next question that we need to examine is that how has the scenario post these crashes, the last 3 crashes, been post that? How has the market behaved? Just to understand, when the subprime crisis market crashed by almost 60%, like I mentioned, within a year, the markets had well and truly gone back significantly to its original mark, if not already to the old one. Similarly, in the recent COVID fall as well, while the fall was very dramatic, within a year from the day of the fall, investors saw 100% returns that for people who had stayed invested. So really, stock market crashes aren't all that bad. They're actually great opportunities for one to grab and to make tons of wealth in the long term.